So many people keep talking about the real estate market and why it hasn't crashed and why it hasn't changed. We have discussed this just beyond it's like we keep talking about it, but we've got to keep talking about it because it's what's in the news. And this is an interesting piece if I didn't mention it to you before, and that is how mortgage holders gained $1.6 trillion in equity in 2023. Now, there's a big change coming about this because these mortgage holders that have all this tappable equity, as they call it, it's going to become a lot more tappable at very reasonable rates. And it's going to give people the opportunity to keep their existing very low interest rate mortgages. This is going to be huge, big news for the real estate market. The highest year-end total on record, which is that $1.6 trillion gain for a total aggregate of $16 trillion in gained equity, right? Look at this, the highest year-end total on record, 2/3 of which is held by borrowers with credit scores of 760 or higher. Now, those of you who don't know, 760 is a very high credit score. 720 is good enough. That's a good credit score, but 760 is a phenomenal credit score. By the way, you know what I've always said about this? If your credit score is too high, because I do see people bragging about this on social media, they'll post pictures of their credit score and they're bragging about it. If your credit score is too high, that means you're not using enough of your credit. And credit, just like equity in property or money stuffed under your mattress, is an unused asset. So make sure you're using it, right? You want to have a good credit score, but not such an incredible score that Dave Ramsey would be proud, because he, when it comes to investing, is completely clueless. He is just clueless about investing. But as I said, to be fair, to give Dave Ramsey credit, he is very good for the audience he serves, the audience of people who have massive credit card debt, who are spending money on the appearances of wealth rather than the creators of real wealth. That's where Dave Ramsey's audience is, and he's good at speaking to that audience. That goes up to, we'll call it elementary school. So when you want to graduate from elementary school and go to junior high or high school or college or, get a PhD in investing, you leave Dave Ramsey. You've already solved those basic problems and you move on to true investing techniques, which one of them definitely involves using leverage prudently and properly to make your real estate portfolio perform even better. The average mortgage holder now has $299,000 in equity, $193,000 of which is considered tappable and could be withdrawn while still maintaining a very healthy 20% equity stake, meaning they would have an 80-20 LTV, loan to value ratio, if they tap that equity. That's if they tapped it. There is so much equity in America right now. Can you imagine? And I'm about to report on this, okay? But the floodgates are about to open on this equity. Now, to some that may sound bad. Well, isn't this reminiscent of the Great Recession and people using their homes like ATM machines? No, it is definitely not the same thing. Why? Because number one, we have a housing shortage now. Number two, the loans are extremely well underwritten. Look at these credit scores. Look on the screen here. Okay. It says low credit score originations. There have been very few low credit score mortgage originations. During the housing bubble, okay, we're talking about the Great Recession there, many of the low credit score loans were made through the private labeled securities market. Remember I talked to you before about Louis Ranieri, right? Someone nobody talks about, but that's the guy who basically taught the world how to securitize mortgages in the early 1980s. And that was game changing. It was world changing, for better or worse, right? Because we saw there was tons of corruption on Wall Street, as there still is tons of corruption on Wall Street, and people abuse that system. But overall, that allowed the mortgage market to massively grow and the real estate market to massively grow. So we have what we have. That's what we have. So here we look at this chart and we see during the Great Recession and leading up to it, 2003, 2004, 2005, 2006. I mean, in 2006 alone, there were 4 million low credit score mortgages originated. Before that, there was about 3.7 million the year before, and about maybe 3.8 million the year before that. And then, even in 2006, you had almost 4 million again. And then 2007, the lenders started to worry, as they should have much earlier. You had just about 2.6 million of those mortgages originated. So add all of those up, right? That's going to be about, I don't know, almost 20 million, right? I don't have a calculator handy. Hey, folks, this is harder than it looks doing this off the cuff. Okay. And you see that that was a massive number of low credit score mortgages, not to mention low equity mortgages, not to mention liar's loans with no income, et cetera, right? These are all credit scores below 660 FICO scores. But since then, there have been very few of those low credit score mortgages. And especially last year, there were less than 400,000 of them. Suffice it to say, the mortgages are very well underwritten. And if you've applied for one in the last 15 years, you know this to be true because they wanted to know your shoe size, your bra size, they wanted a DNA sample, they wanted everything. Okay. They wanted to know everything before they would give you a mortgage. So, completely different world nowadays.